Most people think wealthy investors are playing a different game because they have access to things you don't. Better stock tips, private deals, insider networks. That assumption is wrong, and it's the reason most people, no matter how much they save, never actually close the gap. The actual difference isn't what they own, it's how everything is structured. And the reason this matters to you specifically is simple. The structure they use is not locked behind a minimum investment or a private bank. It's a set of principles. And once you understand them, you can start applying them at whatever level you're at right now. Most people watching this are running a financial structure designed in the 1950s. The people who got wealthy, they quietly stopped using it years ago. Here's what they moved to instead, and what that shift looks like inside your own accounts. For most of the 20th century, the 60-40 portfolio was the standard. 60% stocks, 40% bonds. The logic was clean. When stocks fall, bonds rise. Built in protection. It worked for decades. And there's a decent chance your 401k, your pension, or whatever a financial advisor set up for you years ago is still built on exactly this model. You may never have been told that. Then 2022 happened. Stocks fell 18%. Bonds, the thing that was supposed to protect you, fell 13% at the exact same time. A standard 60-40 account lost around 16% that year. Not because of a crash, not because of bad decisions, because the model stopped working and nobody sent you a memo. If you looked at your account balance in late 2022 and felt like something was wrong, you were right. The structure failed, not you. The world the 60-40 was built for no longer exists. The question is, what are you running instead? Here's what high net worth investors shifted to. The 2026 Long Angle Study, one of the most detailed analyses of how wealthy people actually invest, maps it precisely. Roughly 60% in public equities. That part is familiar, but bonds and cash combined are now the smallest slice, around 10%, and the remaining 30% sits in what they call private and alternative assets, real estate, private equity, infrastructure, real assets that don't move in sync with the stock market. The adoption rate is the part most people find surprising. 94% of high net worth investors have already made this shift. Not some early adopters, not risk tolerant outliers, 94% across the entire high net worth population. What that means for you is this: if your portfolio looks nothing like the 60-10-30 model, you're not behind the wealthy by a small margin in terms of returns. You're running a structurally different machine, one that was built for a world that's changed. A standard 60-40 portfolio has one engine, the stock market. When the market does well, you grow. When it stalls, you stall. When it crashes, as it did in 2022, you have nowhere to go. Your protection is in the same plane as your risk. Wealthy portfolios run multiple engines simultaneously. If public equities have a bad year, real estate is generating rental income. If interest rates compress bond yields, private credit is producing returns. These engines don't all fail at the same time. That's why wealthy investors don't lose sleep over market corrections the way most people do. It's not confidence, it's structure. Their machine keeps running when one part stalls. The question isn't whether you can build that machine, you can. The question is whether your current setup is even close and what it's costing you every year that it isn't. Three specific things the 60-10-30 structure does for you that 60-40 can't. First, it turns inflation from a threat into a tailwind. Right now, US inflation is running at 3.3%. The OECD forecasts 4.2% for the full year. If your money is sitting in a standard savings account earning 0.6% or in a bond portfolio with a fixed coupon, you are on the losing side of that equation every single month. Silently, without a notification, real assets, real estate, infrastructure, commodities tend to rise with inflation. That's not a feature wealthy investors discovered recently. It's why they moved 30% of their portfolios there. They restructured specifically to stop being inflation's victim and start being its beneficiary. If your portfolio doesn't have a meaningful real asset allocation, inflation is a tax you're paying in slow motion. Second, it gives you multiple sources of income, not one. Most standard portfolios produce income from one place: dividends and bond payments. When that one source underperforms, the whole thing feels fragile. You've probably felt that fragility. A 60-10-30 structure generates income from several directions at once: rental yields from real estate, returns from private credit, equity dividends. Not all of these move together. When one is down, another is often holding. The income doesn't stop, it diversifies. That's the practical difference between watching a market correction with anxiety and watching it without one. Third, the compound math quietly changes your outcome. JP Morgan's 2026 projections are specific. A standard 60-40 portfolio is expected to return 6.4% per year. A portfolio with a 30% alternatives allocation, closer to the 60-10-30, projects 6.9%. Half a percent sounds like rounding error. Over 20 years, starting with $50,000, that half a percent is the difference between $168,000 and $195,000, an extra $27,000 generated purely by how the machine was structured, not by timing the market, not by finding better stocks, by asking, what am I actually running? Here's the part most videos skip. They describe the wealthy playbook and then quietly leave you with the impression that you need millions to run it. You don't. The principle is not behind a paywall. You don't need to be accredited. You don't need a private banker or $250,000 minimum. What you need is a different framework for how you think about your money and three specific moves to start closing the gap. Think about what the 60-10-30 is actually doing. It's replacing idle cash with productive capital. It's adding inflation protection. It's building income sources that don't all collapse at once. None of those things require being rich. They require making intentional structural decisions, which is exactly what wealthy investors do, and most regular investors never get taught. The entry points are lower than you think, and the first step doesn't require investing a single extra dollar. Three moves, specific, in order. Move one: audit your actual structure tonight. Before you change anything, you need to see what you're actually running. Open every account: your 401k, your brokerage, your savings. Assign every dollar to one of four buckets: stocks, bonds, cash, real assets. Most people have never done this across all accounts at the same time. They see each account individually. They've never seen the whole machine laid out. Once you do, one number will tell you everything. What percentage of your total money is in real assets right now? For most people under 50, still running a 60-40 or heavier cash position, that number is somewhere between 0% and 5%. The high net worth target is 30%. That gap, that's your starting point, not a reason to panic, a reason to start. Move two: add one real asset, starting small. Two-thirds of high net worth investors hold real estate exposure. You do not need to become a landlord to access this category. REITs, real estate investment trusts, are publicly traded funds that own income producing real estate: apartment buildings, warehouses, office towers, healthcare facilities. You buy them inside your existing brokerage account, the same way you'd buy a stock. You can start with $100. The income they generate, rental yields distributed as dividends, flows directly into your account. I am not telling you what to buy. I'm telling you the category exists, it's accessible, and two in three high net worth investors are already there. Research the options, understand the fees and the underlying assets, size your initial position at whatever level doesn't change your sleep. But get yourself into the category because that one move shifts your allocation from 0% real assets towards something that starts to resemble a modern portfolio. Move 3, stop the cash leak. This is the move that costs you nothing except inertia. High net worth investors keep only what they need liquid, 3 to 6 months of expenses. Everything above that is inside the structure working. Every dollar beyond your buffer sitting in a standard savings account at 0.6% is capital that is losing real value against 3.3% inflation every month. You're not being safe, you're bleeding slowly. The minimum move is this: if you have money above your emergency fund that you're not ready to invest yet, move it to a high yield savings account earning 4 to 5%. Marcus by Goldman Sachs, SoFi, Ali, Fidelity's cash management account, all paying roughly 4 to 5% right now. Same FDIC protection, same liquidity, just a better structure. On $20,000 above your buffer, that's the difference between $120 a year and $900 a year. No investment required, no risk taken on. Just a structural decision that took 10 minutes. Audit your whole machine. Add one real asset. Move idle cash to a better structure. None of these require a financial advisor. None require taking on more risk than you're comfortable with. All three are decisions you can make this week. Here's what ties all of this together and why it matters beyond the three moves. Most people manage their money account by account. What's in the 401k? What's in the savings account? What's in the brokerage? Each one separate. Each one thought about individually. And because of that, most people never see the full picture of what they're actually running. Wealthy investors don't manage accounts, they manage a machine. One system, multiple components, each doing a specific job. They ask, is my machine built to survive inflation? Is it generating income from multiple directions? Is it structured to compound over 20 years? Or is it leaking? The moment you start asking those questions about your own money, not what should I buy next, but how is my whole structure designed, everything changes. You stop reacting to markets and start building something deliberate. That shift costs nothing. It's available to you right now. And the three moves in this video are the first expression of it. Your one action from today. Write down four numbers. What percentage of everything you own is in stocks, bonds, cash, and real assets across every account? Total picture. That one exercise will show you exactly where you stand relative to the 60-10-30 model and give you a specific, concrete first move that isn't guesswork. Next week, we're going deep on the 60-40 portfolio, where it came from, why it worked for 40 years, and the exact mechanics of why it broke. If you have a 401k, and especially if you've never touched the default allocation, that one is going to reframe how you see your retirement account. Subscribe if you want it in your feed. This video is for educational purposes only and does not constitute financial or investment advice. All figures and examples shown are for educational illustration only. Past performance does not guarantee future results. Individual results will vary based on personal circumstances. Nothing in this video should be construed as a recommendation to buy or sell any specific security, fund, or financial product. Always conduct your own research and consult a qualified financial professional before making any financial decision.